Something unusual is happening right now in the silver market. And if you've been stacking or even thinking about it, you need to hear this before that window closes completely. Let me ask you something. When was the last time you looked at the gold to silver ratio and felt your stomach drop? Because if you understand what that number is telling you right now, you would not be sleeping as peacefully as you probably were last night. That ratio, the relationship between what gold costs and what silver costs, is flashing a signal that historically has only appeared a handful of times in the last century, and every single time it has shown up, the people who recognized it and acted became quietly, significantly wealthier. The people who hesitated, they spent the next several years watching from the sidelines, telling their friends that they knew it was coming, but just didn't get around to it. That is not going to be you, not if you watch this entire video, because what I'm going to walk you through today is not some surface-level silver is going up commentary. I'm going to show you the structural reasons, the deep, plumbing-level mechanics of the silver market that are creating a closing window right now. Not next year, not 6 months from now, right now. The window's open, but it won't stay open. And here is exactly what is happening and why it matters so much. Let's start with the price itself, because the number on your screen right now tells a story that most people are reading completely wrong. Silver is sitting around $73 an ounce. And I want you to notice something interesting. Over the last year, this metal has more than doubled. We're talking north of 100% gain in a single year. Now, if you told most retail investors that, they would say the move is over, the easy money has been made, and it's time to look elsewhere. That is exactly the thinking that causes people to miss the most important moves in financial history. Because here's the thing about a doubling in the silver price. It's not the end of the story. It's the beginning of Chapter 2. And Chapter 2 is where things get genuinely interesting. Think about what happened in 1979 and 1980. Silver went from around $6 an ounce at the start of that period to nearly $50 in a matter of months. If you had watched silver go from $6 to $12, 100% gain, and said, well, that's that, you would have missed the 400% that came after it. The Hunt brothers understood what was happening in the supply and demand mechanics of the physical market. They understood that the paper claims on silver vastly outnumbered the actual physical metal available, and they acted on that knowledge in a way that shocked the entire financial establishment. Now, I'm not saying history repeats itself exactly, but the structural similarities between then and now are impossible to ignore, and I want to walk you through them one by one. Before I do that, if you've been stacking silver for a while, or you're trying to figure out how to protect your retirement savings in this environment, I put together a free guide that covers the saving secrets thousands of American retirees are using right now to protect their hard-earned wealth. It's in the description below. Check it out when you get a chance. It lays out practical steps you can take today. Now back to what's happening in this market, because this analysis is important. The first structural driver, and this is the one that keeps analysts up at night, is the industrial demand picture for silver, and it has never looked like this before in the metal's history. Silver is not just a monetary metal anymore. It hasn't been for decades. But the scale of what's happening on the industrial side right now is something categorically different from anything we've seen before. Every single solar panel being installed anywhere in the world requires silver. not a little silver, a meaningful amount of it. And we're not talking about a niche technology anymore. Solar installations globally are running at a pace that would have seemed like science fiction even 15 years ago. Country after country is mandating renewable energy targets. Utility-scale solar farms the size of small cities are being approved and built. And every panel, every connection, every conductive pathway in those systems relies on silver's unique properties as the best electrical conductor on the periodic table. But it doesn't stop there. Electric vehicles. Every EV on the road uses significantly more silver than a traditional internal combustion engine vehicle. The sensors, the battery management systems, the onboard electronics, the charging infrastructure, silver is woven through all of it. And we are watching the global vehicle fleet begin an enormous multi-decade transition toward electrification. We are early in that transition. The silver demand curve hasn't even begun to steepen the way it's going to steepen. And then there's 5G infrastructure, the rollout of high-speed wireless networks across the developed world, and now aggressively across the developing world, requires silver in the antennas, the relay stations, the switching equipment, the devices themselves. Every new phone sold, every new tower built, every new connected device that comes online represents a demand increment for physical silver. What we have, if you take all of this together, is a convergence of demand drivers, the likes of which this market has never seen simultaneously. You have the traditional monetary and store of value demand. You have the industrial demand from old economy manufacturing. And now you have this enormous accelerating green energy and technology demand piled on top. These aren't competing uses. They're all fighting over the same limited supply of physical metal at the same time. Now let's talk about that supply side, because this is where the story gets alarming for anyone who understands the numbers. Silver is not mined the way gold is. The overwhelming majority of silver production, we're talking something in the range of 70 to 80%, comes as a byproduct of mining other metals. Copper mines produce silver. Zinc mines produce silver. Lead mines produce silver. What this means is that silver supply is not responsive to silver's price, in the same way that a dedicated silver mine's output would be. When silver prices rise, dedicated silver miners do ramp up. But the vast majority of the supply is locked to the production decisions of base metal miners who are making those decisions based on copper demand, zinc demand, and lead demand, not silver's price. So you have this remarkable situation where demand is growing rapidly on multiple fronts, and supply simply cannot respond at the pace the market needs it to. The Silver Institute, which tracks these figures meticulously, has been reporting consecutive years of physical market deficits, not surpluses, deficits. The world is consuming more silver than it is pulling out of the ground and recycling. That gap has to be filled from somewhere, and increasingly, it is being filled from above-ground stockpiles that have been accumulating for decades, but are not infinite. This is the window I'm talking about. The above-ground inventory available for industrial and investment use represents a finite buffer between current demand rates and mining supply limitations. That buffer is being drawn down. The window is the period of time before that drawdown becomes visible and undeniable to every investor on the planet simultaneously. Now, let's layer in the monetary argument, because this is where silver becomes particularly interesting for people who are thinking about their financial security over the next decade. Gold is at over $4,500 an ounce right now. That's not a typo. That's where we are. And yet, here is what should get your attention. Silver is trading at a ratio to gold of roughly 60 to 1. Historically, the average gold to silver ratio over the centuries is closer to 15 or 20 to 1. In nature, gold and silver are found in the earth at a ratio of approximately 9 parts silver to 1 part gold. The market has been pricing silver at a persistent and dramatic discount to gold for decades now, and there are structural reasons why that discount is likely to compress significantly. Imagine for a moment that the gold to silver ratio simply reverted to its historical average, not to some outlier extreme, just to the historical average. At $4,500 gold and a 15 to 1 ratio, you'd be looking at $300 silver. At 20 to 1, you'd be looking at $225 silver. These aren't wild predictions. They're simple arithmetic based on historical norms. And the question isn't really whether that reversion happens. Given what is driving precious metals right now, the question is when? And what is driving precious metals right now? This is the part of the conversation that most financial media refuses to have, honestly. The dollar is under pressure from multiple directions simultaneously. The de-dollarization movement, which was dismissed as conspiracy theory just a few years ago, has become openly discussed policy for a growing coalition of nations. The BRICS alliance has been expanding. Countries that previously held large dollar reserves have been quietly, methodically diversifying. Central banks globally have been buying gold at a record pace for 3 consecutive years. They are not buying dollars. They are buying gold. And increasingly, they are buying silver. There's a reason for this. The institutions that manage the reserves of nations, the people who have access to the highest level intelligence about where the global monetary system is going, are expressing a very clear preference. They want hard assets. They want monetary metals. And they are accumulating those assets with a consistency and a scale that is unprecedented in modern financial history. Now, here's what makes this particularly relevant for silver stackers specifically. Silver has a dual nature that gold does not fully share. Gold is primarily a monetary metal. Its industrial demand is relatively small compared to its investment and central bank demand. Silver, by contrast, is simultaneously a monetary metal, an industrial commodity, and an emerging technology input. This means silver benefits from every major macro trend happening right now. Inflation? Silver is a store of value and hedge. Industrial expansion and green energy transition? Silver is the critical input. De-dollarization and monetary system uncertainty? Silver is the hard money alternative. You rarely get a single asset that is positioned to benefit from so many different macro forces simultaneously. And when you do get that kind of alignment, the window of opportunity it creates tends to be finite and tends to close faster than people expect. Let me tell you about the COMEX mechanics, because understanding this is crucial to understanding why the alert in the title of this video is real and not just clickbait. The COMEX is the primary futures exchange where silver is traded in the United States. On any given day, the volume of silver changing hands on COMEX in paper contracts represents an enormous multiple of the actual physical silver that exists in COMEX warehouses. We're talking about situations where 50, 60, 100 or more paper claims on silver exist for every single ounce of actual physical metal available for delivery. This works fine, as long as most of those paper contracts are settled in cash and nobody asks for delivery. But when people start asking for delivery, when they start demanding that the physical metal actually be handed over, the system faces a stress test that its architects may not have fully contemplated. And we have been seeing, quietly and without much fanfare in the mainstream financial press, an increasing number of large players demanding physical delivery from COMEX rather than cash settlement. The inventories have been moving. Metal has been flowing from registered to eligible categories, which is a technical way of saying it's moving out of the system rather than staying available. The LBMA in London is experiencing similar dynamics. The interconnected nature of these two market centers means that pressure in one amplifies pressure in the other. When large institutions are pulling physical metal out of both systems simultaneously, you are watching the early stages of what market veterans call a physical squeeze. A physical squeeze in silver is not like a short squeeze in a stock. It's not resolved in a few days when the short sellers cover their positions. A physical squeeze in a commodity is resolved only when either demand destruction occurs, meaning prices rise so high that industrial users can't afford it and cut back, or new supply comes online, which for silver takes years of mining exploration and development. There is no quick fix. If you want to understand what this looks like in practice, go back and study what happened in the silver market in early 2021, when retail investors began coordinating purchases of physical silver and silver ETFs. The paper price barely flinched initially, but the above-ground physical supply at major dealers was cleaned out within days. Premiums on physical silver exploded. American Silver Eagles, which normally trade at a modest premium to spot, were selling for multiples of their normal premium. You literally could not buy physical silver at anywhere close to the paper price for a period of time. That was a mild, relatively brief stress test. The dynamics building right now are not mild. The demand drivers are larger. The deficit is deeper. The monetary backdrop is more complex. And the number of players who understand what's happening and are positioned accordingly is growing. Now let me address the elephant in the room, because I know some of you watching this have been stacking silver for years. You've watched prices move. You've had periods where you wondered if you made the right call. You've seen volatility. And some of you have heard the silver squeeze narrative before and felt burned when the fireworks didn't materialize on the timeline you expected. I want to speak to that directly because it's important and it's honest. Markets do not move on a timeline that fits neatly into your calendar. The structural forces I'm describing today, the supply deficit, the industrial demand surge, the monetary metal dynamics, the physical squeeze pressure, these forces are real and they are building. But building pressure in a market does not mean the release happens tomorrow. It means the release, when it comes, tends to be significant and rapid, and the people who are positioned before it benefit dramatically from it. The people who are waiting for the move to start before they act are in a structural position to arrive after most of the gains have already been captured. This is the nature of the closing window. Not that the opportunity disappears immediately and completely tomorrow morning, but that each passing day, each new solar installation, each new EV sold, each ounce of silver flowing out of exchange warehouses, each central bank gold purchase, each de-dollarization policy announcement. These things are all nudging that window incrementally toward closed. Speaking of protecting your wealth in this environment, if you're retired or approaching retirement with $100,000 or more sitting in a traditional IRA or 401k, I want to mention something briefly. There are legitimate IRS-approved ways to get physical gold and silver inside a retirement account, a structure called a gold IRA or precious metals IRA. This is not some fringe financial strategy. This is something that thousands of American retirees are doing right now to hedge their portfolios against exactly the kind of monetary system stress I've been describing: the geopolitical pressures, the dollar uncertainty, the institutional de-dollarization, the inflation dynamics. These aren't abstract concerns for someone trying to protect 30 or 40 years of hard work. A gold IRA allows you to hold physical metal with the same tax advantages you already enjoy in your retirement account. If that's something you want to understand more about, the guide in the description covers it in plain language, no jargon, no hard sell, just the mechanics of how it works and who it makes sense for. Now back to where this market is heading, because I want to leave you with a complete picture. Let's talk about the historical parallel that I think is most instructive for what silver stackers are experiencing right now. Not 1980, which everyone references, but 2010 and 2011, which is a far more relevant comparison. In the summer of 2010, silver was trading around $18 an ounce. The financial crisis had just played out. The Federal Reserve had undertaken its first round of quantitative easing, printing money to purchase assets, expanding the money supply in an unprecedented way. Institutional investors who understood monetary debasement were quietly accumulating silver. Industrial demand was recovering as the global economy stabilized. The physical market was tightening. Over the following 9 months, silver went from $18 to nearly $50. That's a 170% gain in less than a year. The people who were positioned before September 2010, who understood the supply fundamentals and the monetary dynamics and the technical setup, rode that entire move. The people who read about it in March 2011 and decided to buy in near the top experienced something very different. The setup today is structurally more compelling than what existed in 2010. The monetary debasement has been larger and more sustained. The industrial demand growth has been faster and is driven by more diverse and durable sources. The supply deficit is more established. The geopolitical complexity driving institutional demand for hard assets is more intense. And silver's starting point, despite the move it's already made, still reflects an enormous discount relative to gold by any historical metric. There's another dimension to this that I want to make sure we cover, because it connects the silver story to something much larger that is reshaping the global economic order in real time. For the last 80 years, the global financial system has operated on a framework built around the U.S. dollar as the world's reserve currency. This framework, established at Bretton Woods, evolved through Nixon's closing of the gold window, and maintained through petrodollar arrangements and geopolitical dominance, is showing cracks that are becoming too significant to dismiss. When Saudi Arabia begins accepting non-dollar currencies for oil, when China and Russia settle bilateral trade in their own currencies, when central banks in Brazil, India, and Southeast Asia diversify their reserve holdings away from U.S. Treasuries. When BRICS nations discuss the architecture of an alternative payment settlement system, these are not isolated events. They are symptoms of a system under structural stress. The dollar doesn't have to collapse tomorrow for this to matter to silver stackers. It doesn't even have to collapse at all in some dramatic overnight crisis. What matters is the directional shift, the gradual, steady erosion of the dollar's unchallenged supremacy, because that shift, even if measured and gradual, translates directly into sustained upward pressure on hard assets. Gold, yes, but silver especially, because of everything we've already discussed. The industrial demand, the supply constraints, the monetary undervaluation relative to gold. This is why the institutions that are accumulating precious metals are not treating this as a trade. They're not planning to sell when they hit some target price. They're restructuring their balance sheets for a world that looks different from the one that existed 10 years ago. They are making a structural call on the future of the monetary system, and they are expressing that call through hard asset accumulation. Now let me bring this back to the practical reality for someone watching this video. The window for silver stackers right now is defined by two converging lines. The first line is demand, rising steadily on all fronts, industrial and monetary, driven by forces that are durable and multi-year in nature. The second line is available physical supply, declining as deficits accumulate, as exchange inventories draw down, as the ratio of paper claims to physical ounces grows increasingly stretched. Those two lines are converging. Where they meet is a price level significantly higher than where we are today. The distance between where we are now and where those lines meet represents the window, and that window has a time dimension attached to it that is shrinking, not because of artificial deadlines or manipulation, but because the fundamental math of more demand and less supply resolving itself is a process that happens whether you're watching it or not. The silver stackers, who have been quietly accumulating for years, understood something that mainstream financial analysis consistently failed to appreciate. They understood that silver is simultaneously the most undervalued monetary metal and the most critical industrial metal of the next decade. They understood that the paper price, set on futures exchanges where most participants never take delivery, does not always reflect the physical reality of the market. And they acted on that understanding consistently, accumulating physical ounces at prices that, from the perspective of where this metal is likely to be in 5 years, will look extraordinarily prescient.